Charlie Munger believed that successful investing is mostly about thinking clearly, avoiding mistakes, and being patient, and his principles work anywhere in the world, including Spain, even if you're investing a relatively small amount like €9,000. One of Munger's most important ideas was the circle of competence. He advised investors to only put money into businesses or assets they truly understand. If you can't explain how a company makes money, what could hurt it, and why it might still be strong in 10 years, then it's better to stay away. You don't need to understand everything in the market, just a few things well. He also emphasized long-term thinking. According to Charlie Munger, real wealth is built by holding good investments for many years, not by frequent buying and selling. Compounding works best when you give it time. With €9,000, this means choosing investments you're comfortable holding through market ups and downs. Munger preferred high-quality businesses at fair prices rather than cheap stocks with poor fundamentals. Quality means strong brands, durable competitive advantages, good management, and predictable cash flows. He often said it's better to buy a wonderful company at a reasonable price than a mediocre one at a cheap price. Another key lesson was emotional discipline. Market volatility does not equal risk. Prices move constantly, but that doesn't mean the underlying value of a good business has changed. Munger encouraged investors to stay calm during market declines and avoid panic selling. In fact, market drops can be opportunities if the fundamentals remain strong. He was also famous for warning against over-diversification without understanding. Owning many investments you don't understand doesn't reduce risk, it just hides it. For most people, this means either concentrating on a few well-understood investments or using broad, low-cost index funds if they don't have time to analyze individual companies deeply. Munger relied heavily on checklists and mental models. Before investing, he would ask questions like, what could go wrong? Is this business durable? Am I being influenced by fear, greed, or social pressure? This habit helped him avoid common psychological mistakes that hurt investors. Applied practically in Spain with €9,000, a Munger-style approach could mean putting a large portion into a low-cost global or European index ETF, then allocating a smaller part to a few businesses you genuinely understand, while keeping some cash for flexibility. The exact assets matter less than following the discipline. Understand what you own. Focus on quality. Stay patient, and avoid unnecessary risks.